In this video, we will talk about Random Walk Down Wall Street by Burton G. Malkiel, so make sure to watch the full video. A Random Walk Down Wall Street by Burton G. Malkiel offers insightful perspectives on investing. It challenges common market myths, advocates for passive investing, and emphasizes the importance of diversification, making it an essential read for both beginners and experienced investors. 1. Understanding the efficient market hypothesis. The efficient market hypothesis, EMH, proposes that financial markets are informationally efficient, meaning that asset prices reflect all available information at any given moment in time. According to this hypothesis, no investor can consistently achieve higher returns than the market average by using any information that the market has already incorporated into stock prices. Malkiel argues that since stock prices already reflect everything known, attempting to outperform the market by picking individual stocks or timing the market is futile. The EMH suggests that the best strategy for the average investor is to invest in a diversified portfolio that mirrors the market, such as through index funds, because actively managed strategies do not consistently yield better results. 2. The power of randomness in stock market movements. Malkiel's core message revolves around the idea that stock market movements are random, and thus unpredictable. In the short term, he challenges the notion that market trends can be forecasted with any degree of certainty, stating that price changes are driven by a multitude of factors that no one can accurately predict. He uses historical data to illustrate how even the most well-informed investors are unlikely to make consistent gains by attempting to time the market or pick individual winning stocks. This randomness, he argues, means that stock prices follow a random walk, making it nearly impossible to consistently beat the market. 3. A historical perspective on investment strategies. Malkiel takes readers on a journey through the history of investing, examining various strategies and their successes and failures over time. He compares the performance of individual stock pickers, market timers, and those who follow more systematic, evidence-based approaches. Historical examples demonstrate how, despite various theories and techniques, the strategies that focused on long-term, broad market exposure have consistently outperformed other methods. Malkiel's historical analysis shows that attempts to identify short-term market patterns or rely on expert predictions have often resulted in underperformance, primarily due to market randomness and the impact of unforeseen events. 4. The case for passive investing. Index funds explained. One of the most compelling arguments Malkiel makes is for the superiority of passive investing, particularly through index funds. These funds track the performance of entire market indices, like the S&P 500, and provide investors with a low-cost way to gain exposure to the broader market. Malkiel emphasizes that most active fund managers fail to outperform the market in the long run after accounting for management fees and other costs. By choosing index funds, investors avoid the costs and risks of active management while still benefiting from the long-term growth of the market as a whole. 5. Behavioral economics. How psychology affects the market. Malkiel explores the fascinating intersection of psychology and investing through the lens of behavioral economics. This field looks at how human emotions and cognitive biases influence financial decision-making, often leading investors to make irrational choices that hurt their financial well-being. Examples of these biases include overconfidence, where investors believe they can outperform the market, or loss aversion, where the fear of losses leads to overly conservative investment choices. Malkiel points out that these biases contribute to market inefficiencies, such as speculative bubbles and crashes. He advocates for investors to be aware of their psychological tendencies and to adjust their strategies accordingly. 6. Risk and return, the balance every investor faces. Risk and return are the two fundamental forces that shape every investment decision. Malkiel emphasizes that there is an inherent trade-off. To achieve higher returns, investors must accept greater risk, and conversely, more conservative investments typically yield lower returns. He explains that one of the keys to successful investing is understanding and balancing this risk-return trade-off. While stocks offer the potential for higher returns, they are also subject to greater volatility, especially in the short term. Bonds, on the other hand, offer more stability but tend to generate lower returns over time. Malkiel discusses the importance of diversification, where a mixture of asset classes can help manage risk while still providing a steady stream of returns. 7. Debunking common stock market myths. Malkiel takes a critical look at several popular myths and misconceptions about the stock market, offering data-driven explanations to dispel them. One common myth is the belief that individual investors can outperform the market by picking stocks or timing market fluctuations. Malkiel points out that this is extremely difficult to achieve consistently and that many professional fund managers also struggle to beat the market. Another myth is the idea that hot tips or insider information can lead to guaranteed profits, when in fact such information is often already priced into the market, and trading on it can be risky and even illegal. Malkiel also debunks the myth that markets are completely unpredictable, stressing that while short-term movements may be random, long-term trends tend to follow more predictable patterns. 8. The impact of speculation on financial markets. Speculation is often viewed as a risky activity, yet it plays a major role in the financial markets. Malkiel discusses the dangers of speculation, emphasizing that it often leads to market volatility, bubbles, and crashes. Speculators, unlike traditional investors, focus on short-term price movements and try to profit from them, rather than investing based on the underlying value of an asset. This speculative behavior can drive up asset prices to unsustainable levels, creating financial bubbles that inevitably burst, causing widespread losses. Malkiel provides examples, such as the dot-com bubble and the housing crisis of 2008, to show how speculation can distort the market and harm investors. 9. The role of bonds in building a balanced portfolio. Bonds are often considered a safer investment compared to stocks, offering fixed interest payments and a return of principal upon maturity. Malkiel explains that including bonds in a diversified portfolio is essential for managing risk and ensuring steady income, especially during periods of stock market volatility. He highlights the different types of bonds, such as government, corporate, and municipal bonds, and explains how they can serve various purposes. In a portfolio, bonds provide a stabilizing influence on a portfolio, reducing overall volatility and smoothing out returns over time. Malkiel suggests that investors should carefully select bonds based on their financial goals, risk tolerance, and the economic environment. 10. Building a long-term investment strategy. Malkiel advocates for a long-term, disciplined approach to investing, built on the foundation of diversification, low-cost index funds, and a focus on risk management. His strategy emphasizes the importance of staying invested for the long haul, ignoring short-term market fluctuations, and avoiding the temptation to chase after quick profits or market trends. Malkiel also advises against trying to time the market or follow the latest investment fads. Instead, he encourages investors to build a diversified portfolio that includes both stocks and bonds, ensuring that their investments are aligned with their financial goals and risk tolerance. What do you think of our video? Let me know in the comments section below. If you enjoyed this video, make sure to hit that like button. Also, subscribe to our channel before you go. Thank you for watching.